Hello everybody, my name is Yordan Zarev. I'm here with my colleague Aleksandar Terziyski, and welcome to our videocast between two VCs, your guide to the world of venture capital investing, startups and innovation. Although it is super hot in Sofia, we are here to discuss some very interesting topics that might be of interest to you, and that might be very helpful for your future endeavors and if you're willing to start up a new company. There is one topic actually that is coming up more and more when I discuss with different founders and people that are willing to start up their new companies, and this is about the topic. This is about the topic. What are actually the KPIs that VCs are looking at, and is there a gap between what we are looking at as venture capital funds and what the founder is willing to report as KPIs, milestones that are achieved? I think this is a very important topic because what you track actually is what you can actually adjust, and the right KPIs to track could be critical for the success of your business. Again, different industries and different business models, different companies require different set of KPIs, and also these KPIs should be more aligned with actually, if you're in the early stage business, with validating your business model, with validating and ascertaining that you're actually delivering value to the end customer. There is a demand for the end customer. Pinpointing KPIs also that are important to demonstrate actually that you're growing in the market versus the competition. But at the end of the day, if we're talking about early stage businesses, we're talking about such KPIs that are demonstrating that the initial hypothesis is actually working, is actually developing. Because if you are measuring the wrong KPIs, you will not be able to pinpoint what is wrong with for example, with the business model or the unit economics. This could be identifying the right KPIs could be done with the help of your investors, which are usually very experienced. They have different businesses, they have seen different business models, and they can tell you what are the right KPIs to track. Of course, the set of KPIs that you're tracking depends also on the stage of development of the company. Initially, you are more looking into proving that the unit economics are working, into that you're actually onboarding more clients, that you're actually generating revenue, and you're validating your value proposition. At the later stages of development of the company, this might be, for example, post-sales, for example, matrices. These are customer retention. This could be, for example, metrics and KPIs that are measuring the upselling of a given product, and also penetration, a deeper penetration into a given customer. These might be also profitability KPIs, which are important for the next funding round, especially in the current environment when there is let's say, more cautious fundraising and fund deploying environment. A lot of venture capital funds are looking at unit economics and the proximity to profitability, and versus what has been the leading theme over the past, let's say, 2, 3, 4 years, which was prioritizing growth versus profitability and cash flow generation. What about you, Alex? What is your experience telling you about this topic?
Well, you are very detailed in your answer and your reply to this question, and you're right. Actually, there are many KPIs and many metrics that are looked at. But I'll try to be more specific than you, and I'll try to single out only one metric, which is kind of a universal for me, or at least as a first filter. And this is going to be number of clients, right? So you show me that you grow your customer base aggressively, and these customers are paying customers, and then well, that's not true, but I really don't need to know much more about your metrics and business, because it speaks about your, of course, monthly recurring revenue. It speaks about your product. It speaks about probably about the founder, and that the founder is smart enough to upsell these clients with new products or new features in future. It speaks about many things, right? Probably doesn't speak about margins too much, but you know, for me, it's number of clients, number of customers, paying customers, and probably everything else is secondary. Yeah, margins are also very important as a second step, second filter. Top to bottom, we have different breakdowns of margins. But yeah, if I have to single out one, it's number of customers, and then the second one, very important, is margins and unit of economics, of course, based on margins.
I would actually kind of build on that. Again, depends on the stage of development of the company. If you're talking about seed stage, early stage companies, I agree with you that you have to identify this KPI that is super important for the company, and that actually demonstrates validation of the investment and product hypothesis, and you should build everything around that KPI. That's for early stage business. As the business evolves, you need to start to be paying attention to different sections of the business, different things of the business. It might be sales, it might be marketing, it might be product, it might be technology, it might be after sales capabilities and processes as well. It might be as well like organizational culture, processes within the culture. So as the company grows, you need to identify the important KPIs that are important for these different sections, and these KPIs should tie together in one coherent, let's say, set of KPIs that are complementary and do not kind of conflict with each other. So this is the recommendation. Early stage, identify one thing that is very important and build a business around it. Try to double down on that, try to validate that. When the company grows, you need to be adding more and more KPIs so that you measure the right things that are right for the business.
Yeah, that's actually very important. We should never forget that metrics, they're usually historical data, right? And we are trying to predict the future, or at least to have some sort of speculation about what the future can be. And especially for later stage companies, it's very important to see how you are scaling your organizational structure, what are your new hires, and you know, with all those resources, human and capital resources, and you know, probably partnership resources and whatever, where you're going to land next year, in 2 years, and so on and so forth.
Yes, and to wrap this up, just try to be adaptive. At one point in time, one set of KPIs might have to evolve, have to transform, and have to differ depending on what is the next milestone, depending what is the strategy of the company, what you're trying to achieve in the next 12 to 24 months. So again, what is important for me and as a recommendation to the founders is to identify the right KPIs to track. Because if you identify the wrong ones, I don't believe this will take you much further ahead of your journey. What I dislike quite a lot is the so-called vanity metrics and KPIs, like getting a reward here, being selected to be finalist in this competition or that competition, number of downloads in an app. You should try to pinpoint the ones that really reflect the pulse of the business, that really actually speak to you, and based on which you will be able to make informed decisions.